everyone, welcome back to our tab and welcome to Finance Current Affairs session. In today's session, we are going to discuss a very important report that is released by the Reserve Bank of India. That is the report on trend and progress of banking in India for the period of 2021 to 22. So this is a very important report that is released by the Reserve Bank of India from the exams point of view, and there is much important data points that has been discussed in this report. So in today's session, let's start with the analysis of this report. But before starting with the analysis, there is a big announcement from EduTab that we have brought for you the comprehensive guide for RBI, NABARD and SEBI. So through a single guidebook, you can get the answers of your common queries. If you want to know about the examination, that what is the pattern for the exam, what is the syllabus for the exam, what are the previous year cutoff for the exam. So through a single guidebook, you can get the answers of all your common queries. Even if you want to know about the preparation, that what should be the strategy for the preparation, what should be the sources for the preparation. So in this guidebook, there are definitive answers for your common queries. Even if you want to know about the examination and even if you want to know about the organization. So do download this guidebook, and this is made absolutely free of cost to save your time, to save your effort, so that you do not have to visit different links, different websites to get the information. And this is absolutely free of cost. You can easily download these guidebooks. The link is provided in the description box below. So do download these guidebooks. So now starting with the report on trend and progress of banking, and this has been released for the period of April, from the period of April 2021 to March 2022. So this is the period, this is for the financial year starting from April 2021 till March 2022. Okay, so this is the report on trend and progress of the banking in India. So this is a statutory publication, that is, it is a required publication by the law, by the act. So this is a lawful publication in compliance with section 36(2) of the Banking Regulation Act 1949. So this is a required, or this is a compulsory publication that has to be made as per the Banking Regulation Act 1949. And now this report on the trend and progress of banking in India for the period of 2021-22, this presents the performance of the banking sector. Of course, this is the report for the trend and progress of banking in India. So this is going to talk about the performance of the banking sector. This includes this presents the performance of the banking sector, including the cooperative banks and the non-banking financial institutions also. And this is for the period till March 31st, 2022. Okay, so remember that this report talks about the performance of the banking sector, including the cooperative banks and the non-banking financial institutions. So now starting with the key highlights, that is the consolidated balance sheet of the scheduled commercial banks registered double-digit growth, that is after a gap of 7 years. So that's why this is a very important point. Remember that it is after a gap of 7 years that we have seen the double-digit growth in the consolidated balance sheet of the scheduled commercial banks, and this is because of the credit growth that we have seen in our country. So public sector banks account for 62% of the deposits of the scheduled commercial banks. So remember that most of the deposits were going to the public sector banks, and they have got 62% of the total deposits of the scheduled commercial banks. While on loans, they cornered 58% of the market share. So 58% of the total loans were taken from the public sector banks. Okay, so this is the important data point that you have to remember. So next is during 2021-22, as the credit growth picked up and deposit growth moderated, the incremental credit deposit ratio reached a 4-year high. So what has happened, that the credit growth was increasing, like in the FSR also, in the financial stability report, we have seen that there was the credit growth that reached to a decadal high, while the deposit growth was moderated. Okay, it was moderated, it was declining by a little. So the credit growth was quite high while the deposit growth was moderated, and that's why the credit deposit ratio reached a 4-year high. So there is an incremental credit deposit ratio that we have seen. Okay, so the credit growth was increasing very fast while the deposit growth was moderating. Credit growth accelerated to a 10-year high at end September 2022. So we have seen that 17.4% of the credit growth was seen in December, as on December 16, 2022. But if we talk about the monthly data, year on year to month data, then we can see that it was 17.5% on September 2022 as on end of September 2022. Okay, so this 17.5%. So the credit growth of banks at 10-year high, if we see from the monthly perspective, it was 17.5% as on end September 2022. So remember this is also from the financial stability report only. The financial stability report has said that as on December 16, 2022, we have seen the decadal high of 17.4% of the credit growth. But this data was also provided by the FSR that if we see of the month, so in September 2022, we have seen 17.5% of the year-on-year growth. That is also a 10-year high. So if we talk about the monthly data, this is the year-on-year, as well as this is the decadal high that we have seen. So credit growth accelerated to a 10-year high at end September 2022, and this was led by the private sector banks. So it was due to the private sector banks that we have seen such credit growth. Okay, and acceleration in income. So of course, if more loans are going, that means more interest income is coming. So an acceleration in income and increment in income has been seen by the banks, while the contraction in expenditure, because of course the deposits are happening less. So on deposits, the banks has to give the bank has to give the interest. So it is interest expenditure that the banks have to do. So the expenditure has happened less, while on the credit the interest income has happened more. So it has boosted the profitability of the scheduled commercial banks in 2021-22, measured in terms of return on equity and return on assets. So the return on equity as well as the return on assets. So loans are the assets of the banks, while the deposits are the liability of the bank. Okay, on the assets, the banks are getting higher interest income, we can say. So I hope you have understood all of this very clearly. You have to remember the data. As on December 16, 2022, there was a decadal high which has been seen last in 2011. So the credit growth was 17.4%. But if we see from the monthly perspective, as on the end of September 2022, we have seen in the month of September 2022, we have seen 17.5% of the credit growth. That is also a decadal high. That is a 10-year high that we have seen. Now coming to the credit to deposit ratio, it is a 4-year high, as well as the acceleration in income has been seen and the contraction in expenditure has been seen. Okay, commenting on the profitability of commercial banks, I have already discussed this. The report said that the return on equity and the return on assets improved to levels last observed in 2014 and 15. So you can see that the return on assets are quite high because the loans are going more and the interest income is coming quite high, as well as the return on equity is also quite high. Okay, so now coming to the capital adequacy of the SCB. So we have discussed about the profitability that was quite high for the banks because of the more loans that are going and more interest income that is coming. Okay, while the deposits are less, so deposits are coming less, and that's why the income interest expenditure is happening less. Now coming to the capital adequacy ratio of the scheduled commercial banks. So at the CRAR, that is the capital to risk weighted asset ratio. Capital to risk weighted asset ratio. So I have again and again discussed about the capital adequacy ratio, or the CRAR that we call it. Capital adequacy ratio is the CAR, or we can call it CRAR also. So how much capital the banks are keeping against the assets that have risk involved. Okay, so assets are the loans, are the asset of the bank. Now when the bank is giving the loan, the bank is going to get some interest. So that is the asset of the bank. The loan is the asset of the bank because the bank is going to get some interest on it. So on these assets, there are some risk involved. If the loan is given to corporate, there is 10%, 20% risk. If the loan is given to bank, given to the government, of course, there is very less risk that is involved, nearly 0% risk that is involved. So the assets has to be weighted according to the risk, like 10% risk or 5% risk, 0% risk. And as per the assets, risk weighted assets, there has to be some capital buffer that has to be maintained by the banks. So it is capital adequacy ratio, that is adequate capital has to be maintained by the banks, and the CRAR, or the capital adequacy ratio of the scheduled commercial banks, strengthened from 16.3% at end March 2021 to 16.8%. So here you can see that in the March 2022. So the financial year that ended in March 2021, the CRAR or the capital adequacy ratio was 16.3%, which increased to 16.8% in March 2022, the year that ended in March 2022. So this is the increment that we have seen in the CRAR. Remember one thing very clearly, that this was the data points that were discussed in the newspapers also, and that's why they are very important. You have to remember them. So the regulatory requirement, the minimum regulatory requirement for the CRAR is what? It is 11.5%. That is CRAR plus the capital conservation buffer. Okay, CRAR is 9% that the banks has to maintain, plus the capital conservation buffer. Some buffer, additional buffer that has to be maintained by the banks is 2.5%. So in total, the banks has to maintain the CRAR plus the capital conservation buffer, that we call 11.5%. So the minimum capital requirement for the banks is 11.5%. Of course, you can see that the scheduled commercial banks has seen quite high than the what they have to maintain. As also the common equity tier 1. So tier 1 capital is the most liquid kind of capital that helps the bank during the distress kind of situation. So that ratio requirement is 8%, which also has been met by the banks. So the banks are keeping above the requirements only. As at the end of September 2022, the capital adequacy ratio of the scheduled commercial banks stood at 16%. So it came down from March 2022, the data was 16.8%, the CRAR was 16.8%, which came down to 16% on September 2022. So remember this also, that the CRAR has decreased for the scheduled commercial banks, but it is still higher than the minimum regulatory requirement. Okay. So next is contingent liabilities. So see what is contingent liabilities. Okay, so we are going to see that the contingent liabilities of the scheduled commercial banks has seen the growth of 23%, the highest in 11 years. So the highest in 7 years, the highest in 10 years, the highest in 11 years, I have told you those are very important. So the contingent liabilities, the growth of the scheduled commercial banks. So the contingent liabilities growth of the scheduled commercial banks crossed 23%, the highest in 11 years. And this was due to the growth of the forward exchange contracts, the acceptances, the endorsements. So first of all, what is contingent liabilities? You have understood the data point, 23%, 11-year high. Okay. So contingent liability is defined as a liability. First of all, it is a liability of the bank. Let's take an example of the bank guarantee. So now the bank is giving a guarantee. I have taken this is 1 lakh rupees. So I have to pay the other MSME, or I have to pay some industry 1 lakh rupees. Now I do not have 1 lakh rupees, but I know that after 1 month I am going to get 1 lakh rupees. So I am going to pay bank 10,000 rupees or 1,000 rupees to guarantee, from my side, to guarantee this industry, or sorry, this MSME, that I am going to pay 1 lakh rupees after a month. Okay, because this MSME is not going to trust me. So I am asking the SBI, or I am asking some particular bank that please, I am going to pay you extra, just guarantee from my side that I am going to pay this 1 lakh rupees after 1 month. So MSME will see that, okay, this big bank has guaranteed on my behalf, so of course I am going to pay. So this MSME has the backing of this bank. Okay, that the MSME, if I am not going to pay, of course the bank has guaranteed, so the bank has to pay. So this is a liability of the bank now. This is the liability of mine. Okay, this is the 1 lakh rupees is a liability of mine, but the bank has guaranteed on this liability. So a contingent liability is defined as a liability which may arise depending on the outcome of a specific event. So this will become a liability of the bank if I vanish or something after a month, that I am not going to pay, that I have gone bankrupt, I have nothing left with me. So then it will become a liability. So the contingent liabilities are the liabilities of the banks. It may become a liability or it may not become a liability. If I will directly pay after a month, of course this will not become a liability for the bank, because the person, that is I have already paid. So this is the 1,000 rupees or 10,000 rupees. This will just be a income for the bank. So a contingent liability is defined as a liability which may arise depending on the outcome of a specific event. It is a possible obligation. Possible obligation. It might be an obligation or it might not be an obligation, which may or may not arise depending on how a future event unfolds. Okay. So it depends on the people, the bank guarantee. So future forward exchange contracts, acceptances or endorsements, these all are the contingent liabilities. It may become a liability, it might not become an obligation or something. As a proportion, so it has grown by 23%. You can see that how much the banks are getting involved in the contingent liabilities. Okay, to earn some extra cash, they are getting involved in these kind of liabilities. That is the liability for some third party. As a proportion of balance sheet size, contingent liabilities increased from 119% in 2020 to 21 to 133% in 2021 to 22. So if we compare the contingent liabilities with the balance sheet, so they have grown from 119% to 133%. The foreign banks contingent liabilities, they are the most involved in the contingent liabilities. So let me show you this data. So here you can see that the foreign banks are the ones that are more than 50%. More than 50% of the total share in the contingent liabilities is of the foreign banks. Then the public sector banks are the least involved in the contingent liabilities. The private sector banks are involved in the contingent liabilities to a level, but the most involved are the foreign banks. So the distribution of the off-balance sheet exposure. So the contingent liabilities comes under the off-balance sheet exposure. So they see, balance sheet exposure of a bank is what? The balance sheet of a bank is what? That how much deposits they are getting, how much loans they are giving. The off-balance sheet exposure refer to the activities that are effectively assets or liabilities of a company but do not appear on the company's balance sheet. So if we are talking about the bank, the direct assets or liability of a bank is what? The asset of a bank is loan and direct liability of a bank is deposits. But if the bank guarantees or the forward exchange contracts or the derivatives, they do not come in the direct balance sheet of the bank. So they will come under the off balance sheet exposures of the bank that the bank has to notify in the footnote, of the balance sheet. So they will not come in the balance sheet, but they will come. The off balance sheet of exposures will be told by the bank in the footnote. So the foreign banks contingent liabilities are more than 10 times their balance sheet size. You can understand that how, like from the assets and the liabilities that they are doing, the deposits and the loans that they are doing, more than that they have the contingent liabilities, and constitute about half of the banking system's total off-balance sheet exposure. So from the total off-balance sheet exposures, more than half or half of the size is with the foreign banks. Their non-interest income, however, has not increased commensurately. So it not has increased much. Even though they are involved in that contingent liabilities, still their non-interest income is not very much. Okay, the most income that they are getting is from the interest payments only from the loans. So I hope you have understood this. The most important data point that you have to remember is that the contingent liabilities has grown by 23%, and that is the highest in 11 years. Okay, and if we compare it with the balance size, if we compare it with the balance sheet size, the proportion of contingent liabilities increased from 119% to 133%, and the FBs, they have the about half of the banking system's total of balance sheet exposure is with the foreign bank. So this is the data points that you have to remember. Why I am telling you this data point is because this was directly in the newspapers. Now let's talk about the asset quality. So we have discussed about the capital adequacy ratio, we have discussed about the credit growth, we have discussed about the contingent liabilities. Now coming to the asset quality, that is also a very big component in describing or deciding that how well the banks are doing. Okay, so banking sector has weathered the pandemic, and the Russia-Ukraine war also came, and the banking sector is weathering all of the distress that is coming very well, emerging more resilient and robust. The banks has reported improved profitability because the interest income is getting higher and the interest expenditure is going lower. So the profitability has increased, the asset quality has improved, that we will see, and the capital buffers, we can see that how improved they are, how much capital buffers the banks are keeping. So the asset quality of the Indian banks continued to improve, with gross non-performing assets as a percentage of the gross advances further falling to 5% in September 2022 if we compare it with the 5.8% in March 2022. So the gross non-performing assets, that is the assets that are not performing for the banks now. Okay, that is the interest income is not coming on these kind of assets now. So what is happening that this gross non-performing assets are decreasing. Here you can see the data in 2017-18, the gross non-performing assets was quite high, and from there onwards there is the decrease in the gross non-performing assets. So the asset quality is improving for the banking sector. But in the March 2022 it was 5.80%, that is quite lower than before. But if we see the September 2022 data, it has further lowered. The gross non-performing assets has further lowered. That shows that how much asset quality has improved. Okay, this decrease was led by lower slippages as well as reduction in outstanding GNPs. So first of all, the outstanding GNPs, the current GNPs, they have decreased through the recoveries that has happened of the non-performing assets, as well as the upgradation that has happened for the gross non-performing assets, that okay, you are not able to pay in 5 years, so pay us in 7 years, in 8 years. So the upgradation of the gross non-performing assets has happened and the write-offs has happened. So lower slippage means what? We have understood that okay, the outstanding GNPAs has decreased, but what is this lower slippage? So the slippage occurs when a bank's loan becomes the non-performing asset, that is the interest on account of the borrower not paying the interest for over 90 days. So if the borrower is not paying the interest, the asset becomes a non-performing assets. Okay, any addition of the NPAs during the year is called a slippage. So you can understand that the slippage has decreased. That means the new gross non-performing assets, they have decreased. So the slippage has lowered, and this is a very big news. This is a very good news for the banks. Okay, I hope you have understood this completely. Now coming to the frauds, the key highlights regarding the frauds. So the banking frauds have implications for the financial stability, because if there are too many frauds that are happening, it decreases the trust of the consumers in the banking system, in the financial system of the country, as they are a source, the frauds are a source of reputational, operational and business risk. So if a single bank, like if the private sector banks, there are too much frauds that are happening there, so of course we will loosen our trust on the private sector banks and we will move to the public sector banks or something. So this kind of the frauds, they are a source of reputational, operational and business risk. They create a bad reputation for the particular banks, along with endangering the customer's trust in the complete banking or financial system. So here you can see that if we see in the number of frauds term, for 2 continuous years, the public sector banks are the ones that have very high number of frauds that are happening in the private sector banks. Next is amount involved. But if we see in the amount involved, like you can see that for the private sector banks, the amount of the frauds are quite less. So here during the 2021-22, the average amount of frauds decreased substantially. So that is a good news for the country. The number of fraud cases reported by the private sector banks outnumbered those of public sector banks for the second consecutive years. For the second consecutive years, we can see that for the private sector banks, the number of frauds are more. But in terms of the amount involved, the share of public sector banks was 66.7% in 2021-22 as compared with 59.4% in the previous year. So I hope you can understand that actually the amount involved has increased. The amount involved has increased for the public sector banks. So that is a bad news for the public sector banks, and they have to reduce this kind of inefficiency. Okay. So now coming to the sectoral deployment, here you can see the sectoral data, that how much credit is going to which sector. So here the most credit is going to the service sector, and then to the retail loans, the credit is going to. Then the agriculture sector is getting 9.5% of the gross loans, and then the industry sector. So the highest sectoral deployment of gross bank credit by the scheduled commercial banks is happening to the service sector, and then to the retail loans the deployment is happening of the gross advances. Okay. So next is bank branches. See, for the last 2 years, there is the two consecutive years, there is the decline in the bank branches. If we see in the percentage terms, opened by scheduled commercial banks increased by. But now what has happened, that the new bank branches opened by the scheduled commercial bank has increased by 4.6% during 2021-22. So here you can see that for 2 consecutive years there was a decline that was happening in the bank branches. But now in the third year, what has happened, that there is improvement or there is increase in the number of bank branches. There are new bank branches that has been opened, and there is the 4.6% of the increase that has happened of the new bank branches by the scheduled commercial banks. So the growth was led by new bank branches opened in tier 4, 5 and 6. So here you can see that 4, 5 and 6 from 8.5% to 9.1, from 5.7% to 7%, from 11.3% to 15.7%. There is the improvement or there is the increase in the bank branches for the tier 4, tier 5 and tier 6. So there is the growth that is led for the new branches that is opened in these tiers, and they are the low tiers. So you can understand that if for the low tiers the new bank branches are opening, that means we are developing and we are trying to go to the far off areas. Okay. Although the share for tier 2 and tier 3 centers in new branches declined in 2021-22. So here you can see that from 9% to 7.3% and from 15.6% to 13.2%, we have actually decreased the we have decreased the percent growth in the number of branches in the tier 2 and tier 3 centers. Okay, so the share has declined in 2021-22 from a year ago if we compare it with a year ago. More than half of the new branches opened during the year were in tier 1 and tier 3 cities. So you can see that in the tier 1 there was 47.7% of the branches opened in tier 1, and there was 13.2% of the branches that were opened in tier 3. So the highest number of the branches were opened in tier 1, tier 6 and tier 3. Okay. So this is the data point that you can easily remember. Okay. So here the most important thing is that the growth was led by new branches that is opened in tier 4, 5, 6. Highest, more like nearly half of the new bank branches are opened in tier 1. Okay. So this is what you need to understand and remember. So the data regarding the urban cooperative banks and the non-banking financial institutions we are going to discuss in next session, because this session is already quite long, and in the next session we will also do many of the questions for the revision. So you will be easily able to revise the data points, and you will be easily able to understand that how much you remember from the current video and from the next video, okay, from the report on the trend and progress of the banking in India. So in the next session, we will discuss about the urban cooperative banks, the progress in the non-banking financial institutions, as well as we are going to discuss, we are going to do the revision of the complete report on trend and progress. Okay. So thank you very much. If do subscribe to our YouTube channel, and the PDF of this session you are going to get in the Telegram channel. So do join our Telegram channel. And here, if you have any query, you can mail us here or you can contact us through this number. Thank you very much, everyone.